we've stuck to the bearish dollar view that we came into the year with. And it really was built on two main pillars, which was, on the one hand, low real yields in the US, obviously underscored by a very dovish Fed, and ultimately a pretty synchronous global recovery. And we do think that those two themes broadly still apply. But as you mentioned, we're going into a pretty important payroll report this week, which comes following some notable shifts in Fed communication. So clearly we're moving towards some form of tapering of asset purchases later this year. So it is a little bit of a noisy period, but we think it is really noise. Ultimately, we think the dollar will go lower in terms of the dollar index, in terms of the broad dollar, but against the majors, and in particular the euro as well.
Ebrahim, is there anything in the upcoming non-farm payrolls report for jobs due on Friday that would change your opinion here? Or do you think, again, the market reaction would be short-lived if we have a number that blows past expectations?
So in the grand scheme of things, we think the reaction will be short-lived. That being said, I do think that payroll report matters quite a bit. If we get, let's say, a 1 million plus number in terms of employment growth, then I think we might well get a bit more of a hawkish signal at the June FOMC. And then maybe even September is a plausible date for actually announcing tapering. So 1 million run rate could really make a difference towards the timing for tapering. And I think the market would be taken a little bit aback. Again, I don't think that would make a great deal of difference beyond the next, let's say, couple of months. But I do think it would make for a much more interesting summer in the context, obviously, of some overarching concerns about the overheating of the US economy and maybe some upside inflation surprises. So I think employment growth by itself is going to be the most important aspect to look at in this jobs report.